Hello, thank you for joining me. Dimitri here with Sense Financial, and welcome to the presentation about solo 401k, which is the ultimate retirement plan. Before I begin, just a quick introduction about myself. I'm president and founder of Sense Financial Services. Our company specializes in creating self-directed retirement accounts with checkbook control. And a quick disclaimer, we are not a fiduciary. We do not provide legal or tax or investment or accounting advice. And if you do need such advice, please talk to the professional in this area. But my expertise again in self-directed retirement accounts, and hopefully you will learn a bunch from today's presentation. Take some notes, and let's get moving. Now, just a quick cartoon here. Credit goes to my daughter Giselle, and two men here, and a husband, man and a wife there. And the husband says, I finally decided to put something aside for our retirement, and that's our plans to retire. And you might be in a similar situation if you've been looking at your 401k or IRA statements and seeing the value goes down over time because of the performance of the stock market. You're not alone, and hopefully this presentation will give you some hope. There are other options, there are other alternatives, and you can actually do something about your future, about your retirement. And so please take notes and then take action. But to begin, just wanted to basically help you understand the difference between conventional retirement accounts and self-directed retirement accounts. The conventional retirement accounts are controlled by a custodian who only allows investments in stocks, bonds, and mutual fund. And this is an example. When I used to work for a company years ago and we had a 401k, their representative will come and meet with all the 401k participants once a year and give us a sheet similar to this one. And these were the investment options that were available to us, or if you have a 401k, you'll have a similar options. And as you can see, very limited investment options, and all of them are confined to the stock market. That's the only thing that you can invest in. And unfortunately, you and I, we have no control over the stock market and its performance. But the self-directed retirement accounts allow you to be invested in a variety of different investment opportunities. We call them non-traditional, and that can be real estate, tax deeds and tax liens, trust deeds. You can invest in private businesses. You can even invest in real estate internationally. I do have clients who invest in India, Canada, Japan, Mexico, and again, opportunities are just limitless. Just a quick example here of Jason, who is actually one of our clients. He lives in Tallahassee, Florida. Found us online. He had a couple different accounts valued just over $100,000. Just like many people that he knew, he was losing money in the stock market because of the investments and the performance of his IRA and 401k, and he was concerned about, with all the out of control spending and the debt that is out of control, he was concerned about government coming in and even taking some of or portion of his retirement funds. So he actually did some research, contacted us, and we were able to set up a self-directed solo 401k plan for him. And he made some investments. He purchased a rental property with it. He invested in his brother's manufacturing business, and he also lent out remaining funds to another investor. So he actually became a bank, and he now holds a real estate note that is secured by real property, and he's getting about $1,000 a month in return, in cash flow from these investments, and this is not counting the potential appreciation. So from being invested in a stock market and actually his account balance going down to receiving stable $1,000 a month in return every single month, and with much greater potential for the appreciation, you gotta ask yourself, is he in a better position or than before? This is kind of like a IRA makeover or 401k makeover that he received, and the same thing can happen to you if you're willing to take the time to educate yourself and to use the right tools. You can achieve the same thing, and opportunity is just limitless. So what is a solo 401k? A solo 401k, as defined in the Internal Revenue Code section 401, is a retirement savings trust, and it's designed for those people who are self-employed or own small businesses. It's not a new type of plan. Basically, it's your traditional or conventional 401k plan covering only the owner and a spouse. So it's a simplified 401k, if you want to put it that way, because there is no other employees. It's very easy to administer, and you don't have to do a bunch of things that you will have to do if you had a company with employees that you have to offer 401k plan to. Increased interest in these types of plans started as a result of changes in the tax laws in 2002, and these changes made the current benefits of the solo 401k possible, and there are several of them. They're really major one. I'm very excited to share about them with you, so again, take some notes. Now, who is eligible for a solo 401k? It's not for everyone. There is two eligibility criteria that you need to understand. Number one, it is the presence of self-employment activity. You have to be self-employed or own a business, and it can be any type, shape, or form. Just a few examples here: a doctor, attorney, consultant. If you are a real estate investor and flip properties, or you have a portfolio of properties that you manage yourself, you can be the property manager. If you're a day trader, you can do that as a business, and pretty much anything that generates earned self-employed income that you pay in self-employment taxes on, then that will qualify you. And that can be part-time or full-time. It can be in addition to the full-time job that you have elsewhere, and you can just have a side business. And then number two eligibility criteria is that the absence of full-time employees. And full-time employee definition by the IRS standard is somebody who is working for you more than 1,000 hours a year. That's about 20 hours a week. So you're actually allowed to have a part-time, maybe assistant or part-time employee working under 20 hours a week. Then it's going to be less than 1,000 a year, and you can still have a solo 401k. So basically, the only thing that will disqualify you from doing a solo 401k is if you have a business with full-time employees. If you don't have any business, it's not hard to start a business or become a self-employed. In fact, you should be thinking about that, because if you have a job, job, you work for someone and you think you have a secure job, think again. You don't own that job. That job can be taken away from you. Some jobs are more secure than others, but nonetheless, it's not your job. You don't own it, and you can lose that. So it's always good to have a backup plan. It's always good to have multiple sources of income. I learned that early on, probably 15 years ago or so, from authors of the book called ABCs of Making Money, and they talk about creating multiple streams of income. So if you have a job, great, that might be your main source of income, but you also want to think about creating other sources of income, and that can be just becoming an investor, buying rental properties or doing flips or whatever you want to do with the real estate. But another source of income can be just starting your own business. There's many ideas out there. I'm not gonna spend time on this, but that's a whole different presentation. So think about that. Now let's talk about the benefits of the solo 401k, and that's the part that I'm most excited about today, because they're really superior benefits compared to that are offered by an IRA. Number one, a solo 401k has a high contribution limits. The contributions consist of two parts, because when you're self-employed, you actually wear in two hats. You wear in the hat of an employee and you wear in the hat of an employer. So for example, if you're a real estate agent selling properties, you work for yourself, so you're the business owner, but you're also the agent. You out there meeting with clients, showing the properties, and earning commissions as a result of that. So as an employee, you can contribute up to $18,000 per year, which can be up to 100% of your self-employed earnings. And if you're over age of 50, then you have additional $6,000 in catch-up contributions. So this $18,000 or $24,000, including catch-up, can be contributed both pre-tax, so you get a tax deduction, or if you wish, you can contribute them into a Roth bucket of the 401k. That's another benefit which we will cover a little bit later. Now the second part is employer profit sharing contributions, and that's can be up to 25% of your self-employed compensation. If you're a sole proprietor or single member LLC, it goes down to 20%. And these contributions are made by the business. So if you have a corporation contributes that. If you're a sole proprietor and you report your income on Schedule C, then that will be an expense of the business, expense that will show up on Schedule C. So the total limit on both contributions is $53,000 per year. And if you're over 50 years of age, you can take advantage of the catch-up contributions, and that raises total limit to $59,000. Now if you're a husband and wife working as a team in the same business, that doubles. So you can potentially shelter $118,000 together as a family, as a husband and wife. I mean, think about the impact on your taxes. If you're able to shelter over $100,000 from your taxable income, what will it do on the bottom line? How much less taxes you're gonna pay? So this is a great tax sheltering vehicle, and again, it's a great savings vehicle as well, because I've seen in the past, I've been in financial planning, and I met with a lot of families who just help them with the basic financial planning. I've seen people make a lot of money, but they spend it all. They don't save. And Proverbs 21:20 says, "The wise man saves for the future, but the foolish man spends whatever he gets." So don't be foolish man, be wise man, and save. Because we don't know what's going to happen tomorrow. So it's always wise to plan for the future. And the solo 401k is the vehicle that will allow you to do so. Now, next benefit is the solo 401k loan feature. And this feature allows you to actually access your retirement dollars before you even retire as a loan. You can actually take a loan from your solo 401k. It's the same if you had a 401k ever with your employer, then it probably came with the loan feature. So it's the same feature. The loan is amortized over 15 years. I'm sorry, over 5 years, and if it's used for the primary residence, it can be a 15-year loan. You have to make payments on the loan monthly or quarterly. The interest rate is set at prime plus 1%, and the interest that you're paying on the loan actually goes back into the 401k. So your 401k receives principal and interest, so you're not paying any third party. The loan can be used for any reason, for any purpose. So you can access up to $50,000 for 50% of the account balance, whichever is less, without taxes and penalties. IRA does not offer such feature. You can't even take a penny from an IRA. So you can use this to invest in transactions that otherwise will be prohibited with an IRA. So basically what you're doing with this is you're creating your own bank that will never turn you down. You have that feature available. Next, Roth contribution. As I mentioned earlier, the employee deferrals can be contributed in either pre-tax or it can go into Roth. It can be contributed post-tax. And the limit is again $8,000 plus $6,000 catch up for those who are over 50. And if you compare that with a Roth IRA, it's $5,500 versus $1,000. So only $6,500 is the maximum versus 24. And another important key comparing that with a Roth IRA is that with Roth IRA, if your income is over a certain threshold, you may not be able to contribute to a Roth IRA. But contributions to Roth 401k can be made regardless of your income. You can be making $500,000 and you can still be eligible to contribute to a Roth 401k. When you do contribute to Roth 401k and you invest, all of the income and gains will be tax-free, and you can access your contributions actually at any time. And if you have pre-tax money in your 401k, you can do what's called a Roth conversion. You can pay the taxes now and convert them into Roth, so you can have tax-free income later in life. Next feature is checkbook control. The solo 401k plan is a truly self-directed solo 401k plan is really cost effective because it allows you to have a checkbook control, and you can open up an account for your 401k trust. Shortly I'm going to show you the diagram so it will make more sense for you, but you can actually open up an account for your 401k trust at any bank, credit union or brokerage. Custodian is not required with the solo 401k, unlike with an IRA. So you eliminate the custodian fees forever, period. You eliminate the red tape and delays that are associated with the custodian forever. You serve as a trustee of your 401k plan. That puts you in control. That makes you or gives you the ability to act quickly, immediately. You don't have to go to a middleman. You don't have to go to a custodian or administrator to request execution of certain transaction. You can do that immediately. If you see an investment opportunity, you can simply write the check and make the investment right away. It's very simple to operate. There is no annual filing requirements except filing short form 5500 easy, and that is required if the plan value exceeds $250,000. So if you have more than $250 in your 401k, then you will file this simple form 5500 easy, which is only 2 pages long. It is used to report the value and the contributions you made over the during the year into your 401k plan, and we do help you complete that. So again, from the administrative standpoint, they're very easy to maintain. You can also invest in real estate with your solo 401k plan. All of the income and gains generated by the investments are deferred from taxes. You pay taxes at the future date rather than now, and that's the key. The key is deferral. When you're able to defer your taxes, paying taxes on the gains and on the income, you're allowing your investment to grow much quicker, much faster, because again, if you invest in just in your name and you receiving say if you're a private lender and you invest in trust deeds and doing private lending, the income that you receive from that will be taxable in the year that you receive that. But if you do it in a retirement account, it's going to be sheltered from taxes, and it's going to allow you to grow the value of your 401k much quicker. Now, if you do invest in real estate using a Roth 401k, then all of the gains will be tax-free. And another important component is that all of the income that is generated by the investment must go back into the 401k. You can't use that right now because it doesn't belong to you, it belongs to the 401k. And all of the expenses related to the investment must be paid from the 401k. So you cannot commingle your IRA, your 401k and your personal finances. Question that is often comes up: can you finance real estate inside of a 401k? And yes, the answer is yes, you can finance purchase of an investment property inside of your retirement account, but few things that you need to be aware of. Number one, you can't provide personal guarantee because you're a disqualified person. We'll get to that in a moment. You cannot provide personal guarantee on financing. For that reason, the loan must be non-recourse. And non-recourse simply means that the lender has no other recourse against you or your 401k. The only recourse the lender has is the property itself. So when you buy a property in your 401k and you get in one of those non-recourse loans, if you default on the property, the lender cannot come after you personally, cannot take any of the assets in the 401k. The only recourse they have is to take the property that is used as the security for the loan. They typically require 30 to 50% down payment depending on the property type and the location of the property. The property must show cash flow. In other words, the property must have sufficient income to cover all of the expenses, and that is the mortgage payments, property taxes, insurance, property management. And you also must have enough cash reserves to basically sustain the property if something unexpected happens. And if you do that inside of an IRA, if you buy a property using leverage inside of an IRA, it will trigger unrelated debt finance income tax. However, 401k is exempt from the UDFI taxes on leveraged real estate. So this is another cool feature. There is only select banks and private lenders that offer these types of financing, and I provided a link for your reference here, SenseFinancial.com / non-recourse lenders separated by hyphen, and you can go and you can see we have several lenders that we found over the years that provide this type of financing, and we have this as a resource for you. So let me just expand a little bit on the UDFI tax. So when you buy real estate using the 401k, the unrelated debt finance income tax will be due, and the UDFI is a type of UBTI, and UBTI stands for Unrelated Business Taxable Income, and the tax rates on this type of income is at 39%, the top, and it is triggered by leveraged real estate and an IRA. It is exempt in the 401k, and this is done to make the playing field level for everybody, for profit organizations as well as non-profit. So that makes the solo 401k plan very tax efficient solution to buy real estate that with leverage. Another cool feature of the solo 401k is that it allows you to combine multiple accounts. If you have other accounts such as traditional IRA or SEP IRA or simple IRA or employer sponsored plans, you can combine them. You can solo 401k will accept rollovers from all of those types of accounts, with one exception, and that is a Roth IRA, because there is different rules and distributions for a Roth IRA. So IRS does not allow Roth IRA to be rolled over into a solo 401k, even though it has a Roth component, but you cannot do that. And also keep in mind that if you have an employer sponsored plan, Typically, if it's with the current employer, you cannot touch that, you cannot roll that over. But the previous employer 401k, you can roll over. If it's with the current employer, you can inquire if they offer what's called the in-service distribution. Some companies do have some exceptions, and they will allow you to roll over plan even if you're employed for that company. But again, that's more of an exception. Now, self-directed means unlimited investment options. We talked about this, but just again, another example here. You can invest in precious metals, gold, silver. You can invest in real estate. You can do hard money loans. You can invest in commercial property. You can invest in private companies. You can invest in trust deeds and tax liens and more. The investment potential is pretty much unlimited. It also offers you a true diversification. Again, another cartoon here, man standing with the basket and the bottom fell off and all the eggs are gone now, and the basket represents the stock market, and wife says, I thought that our investments were diversified. Well, if you invest all of your or if you put all of your eggs in one basket, then that is a possibility. You know, the bottom may fall off, but if you diversify, then you will be in good shape. Again, Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. None of us knows what tomorrow may bring. We can plan for it, we can try to predict that, but none of us knows for sure. So being diversified or have diversified portfolio, whether it's your personal investments or retirement, is just a wise thing to do. Just a quick comparison of solo 401k with a SEP IRA, because some people think mistakenly that SEP IRA is the best account for self-employed people. Well, with SEP IRA you can contribute 25% of the compensation up to $53,000. With solo 401k it's 53 plus the catch-up, so that's another bonus here, that you can do the catch-up. So in this example, if you self-employed and make $100,000, with SEP IRA you can contribute $25,000, and you have to make $212,000 in income in order to maximize your contributions. In other words, in order for you to contribute $53,000 with to a SEP IRA, you have to make $212,000 in income. Now, with solo 401k, you have a salary deferral in addition to the profit sharing. So with the same $100,000 income, you're able to contribute $48,000. And you can put the maximum at only $140,000 of income. So as you can see, solo 401k is a much more powerful, not talking about other benefits, you know, not having a custodian and a loan feature and so forth. So how does the solo 401k works? First, you have to have the sponsor of the plan, and that again is your business, if you have a business, or being a sole proprietor. Okay, so you have to have that in place. You need to have a legitimate business activity in place. Next, a solo 401k plan is adopted by the sponsor, and plan and trust is created. So the solo 401k trust is used to hold all of the assets of the plan, and you, a little man here, as acting as a plan trustee. So as a plan trustee, you control the assets of the plan. So once the plan and trust is created, you can go to any bank or financial institution of your choice, and you can open up an account for a trust. It's going to be in the name of the 401k trust using a trust tax ID number. Trust will have its own tax ID number. And then as a trustee of the plan, you will direct the investments. You can buy a real property, you can become a private lender, and you can do loans out of the 401k, and all of the income and expenses will be going in and out of the bank account for the 401k trust. So it's very easy to manage, very simple structure, and that gives you a lot of control. Now, let's talk about prohibited investments and things that you cannot do. And the prohibited investments are outlined in the Internal Revenue Code section 4975, and it says that the only investments that you cannot make with your 401k is collectibles. So anything that is collectible, and just examples here, a stamp or a coin or an artwork, it could be a collectible rock. So anything that is collectible, you cannot invest in. And you cannot invest into the S Corp because it only a person can be part of the S corporation. You can invest in the C Corp although. Now, in addition to this, the same section outlines the disqualified person, and disqualified person basically is the plan participant, his or her spouse, and then any linear ancestors and descendants and their spouses, and then any entities in which disqualified person holds a controlling equity or management interest. And we'll cover some of the examples there, but exceptions to that will be your brother and sister, your cousin, aunt, uncle, or a friend. The easy way to remember that is vertical. So basically you can go vertically, you cannot go vertically, basically your parents, your grandparents, your kids and grandkids and their spouses, but it is okay horizontally. So your brother, your cousin, your uncle, your nephew are okay to do business with using your 401k. So let's look at the prohibited transactions. Solo 401k plan prohibited transaction rules listed under Internal Revenue Code section 4975, and basically prohibited transactions are direct or indirect, and let's talk about each one of them. Sale, exchange, or leasing of any property between a plan and a disqualified person. And so the example for this particular prohibited transaction is that if you buy a property in your 401k, and your daughter's family, for example, needs a place to live, you will not be allowed to rent it to your daughter because she is considered to be a disqualified person. The next one is lending of money or other extension of credit between a plan and disqualified person. So again, if you buy in a property, you personally cannot provide a loan to the 401k because you're a disqualified person, and that is prohibited. You have to get a non-recourse financing. Next example is furnishing of goods, services, or facilities between a plan and a disqualified person. So if you are buying a property, let's say it's a fixer-upper, and your father happened to own a construction company, you cannot hire your father or his company to do the work on the property because he's a disqualified person and he's not allowed to provide any services to the plan. Next, transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. And that is basically if you receive an income on behalf of the 401k, all the income belongs to the 401k. You cannot use that until you actually take a distribution. Act by a disqualified person who is a fiduciary, where he deals with the income or assets of the plan for his own interest. Remember that you're wearing a fiduciary hat here. You have a fiduciary responsibility to the 401k to act in the interest that is best to the 401k, not your own interest. And then finally, receiving any consideration for your own personal account by any disqualified person who is a fiduciary from any party dealing with the plan in connection with a transaction involving the income or asset of the plan. Another example for this one is many of my clients are real estate agents. So if you're a real estate agent and you want to buy a property for your 401k, you have to have another agent represent this transaction. You cannot be the agent acting in this particular transaction, because again, you're a disqualified person and you're not allowed to do so. You don't have to have an agent. So your 401k plan can purchase a property without an agent, but you personally cannot represent and receive any consideration or any compensation for that. Regardless if you're receiving the compensation or not, services cannot be provided. So that concludes my presentation. I know I had a limited time to fly over this, and it's a bit of compressed, but if you do have any questions, you're welcome to contact my office. This is my direct line and my email. You can request a complimentary consultation, and we can just sit down and we can chat about your goals, we can chat about your situation, and we can help you come up with the game plan that is suitable for your particular situation. Again, thank you for joining me today. Hope it was profitable for you, and enjoy your day. Bye bye.